How to invest in the Wyckoff trading strategy. For you to invest in this strategy, you just need a short times graph, like 15 minutes, and volume. Remember that all markets have volume, except FOREX. That is the only one that does not have a center where you can see all the transactions. Because of that, this strategy is not applicable in FOREX, but you can use it in all the other markets. We just need an indicated volume. It is not necessary that the volume is real. It can be an indicator of volume, since its measurement is ticks, and it gives us a sufficiently precise reference. For this strategy, before you make an analysis, the first thing you must do is use zoom so you can move away from the graph and find important points where the market turns around. When we analyze the general view of the graphic, we do not dominate a macro analysis because we are analyzing bigger movements. Once we locate the points in the market, we draw horizontal lines in all the points. Try not to abuse this technique. We just need the clearest points so we can have a general view of where the market changes the trend. The second step is to search Google the investing calendar, then click on the filters button. Inside this we will click the clean option and then we will select the country where our asset is. For example, if you operate in NASDAQ, SP 500, or any American share, you must select. If you invest in any European company, you will have to select the Eurozone, and if it is about cryptocurrencies, you need to select both options. We move to the impact section, and we will select the 3 starts. What is the news that has more impact on the market? It is important to know the time in which they happen so we can avoid them. Once we have clicked on everything, we click on Apply. This will show us all the news that can apply to the market and that has more power than any technical analysis strategy. Since we are investing in low temporalities, it is crucial to avoid any new. If not, our strategy will lose power. We see the time in which the new appeared, 15 minutes before and 15 minutes after. After that time, we will avoid making any operation. So, do not forget this. You can draw in your graph a vertical line at the time in which the news will happen, so you can see every time when you do not need to invest. Once we do that, we put the graph close again so we can do our microanalysis. When we talk about a macro analysis, we are talking about bigger movements, but with a microanalysis, we are talking about small and exact movements. It is where we are going to look for our operations. At first sight, we see that the price falls and a relevant volume appears. After the volume appears, we see that the price is going up. This strong volume and the fact that the market turned around while it was falling just tell us one thing, and it is the fact that the trader that can manipulate the market does not want the price to continue falling. That is why we will draw a zone here so we can take it into consideration. This is the first step. In our second step, our objective is to look for a peak. In this case, we see that the price has reached this area, and where we have our possible resistance, we are going to draw the zone. Now we will take into consideration this channel for the next market movements. And the most important thing is that we will ignore everything that happens on this channel, since it is probable that the trader is manipulating this market. It just wants a single thing, that we sell all the positions without the price going up. That is why it will make appear candlesticks patterns, figures, or crosses of moving averages, because it knows that doing that will not be a strong avalanche of sales. We must ignore these signals because all of them are going to be a trap. Here we can see the first lie. We have a breach below, and remember step 2, we do not need to believe in anything that we see. In this case, it is a false breach. We know that a big trader wants the price to go up and it will not let the price continues falling. We can confirm this with volume. If we see the volume is high, and as a rule, we should see a high volume but not as high as the one that made the price change its course. As in step 1, we can draw a line to confirm that it is a little bit low. Since at this point, we already know that the interest of the trader is to buy, here we can take our first operation of the Wyckoff method. Our stop will go below the performance and our take profit can be micro or macro. If we choose macro, our take profit will be in the resistance, and if we are more ambitious, our take profit will be in the next level that we have drawn in the macro graph. Remember that this operation is one of the 4 that you will learn. And since it is the first, it is riskier because we still do not have a lot of evidence of what the traders that are manipulating the market want to do. When the price looks for the higher point of our zone, we need to make sure that it is doing that with volume. This confirms that the trader is manipulating the price up and that it is interested in the price going up. In step 5, we see again false knowledge. As you can see, we have a high volume, which means that with every deception that made us, it starts to accumulate more and more positions. Before shooting the price upward, we need to be attentive to this breach, which sometimes happens, and sometimes does not. But do not be fooled, the big trader does not want that the market goes up yet, it is still accumulating bullish operations. We see that the price goes back to our support, and in this step, we need to check our volume. Our volume should be small, which would confirm that the trader does not want the price to continue falling. That means his interest is bullish, and it is here where we have a second opportunity to enter to the market. Again, you could make a micro or macro entry. We will look to place our stop in the zone of the false breach, and we would place our take profit in the resistance, in the micro entry. And for our macro entry, our take profits will be in the closest area that we have traced. In macro, we see the price approaching the resistance with a big volume. This indicates that the trader is manipulating the price so it can go up strongly, so finally, it can break the resistance. And now we have the price again going back to the rank zone, but we must be very attentive with volume. Volume is low when the price stops in our rank, and that means that the trader does not have any interest in the price to continue falling. Here the Wyckoff method gives us a third entry opportunity, and according to Mr. Richard Wyckoff, this is the safest entry. It is a micro entry, and since the price already traveled a great trajectory, it makes it very safe. We know that the big trader wants the market to go up. In this opportunity, we will place the stock inside our rank because thanks to volume, we know that the big trader does not have interest in entering inside. And our take profits will be at the same distance that what our range measures, and we project it up. This will be our take profits. As you can see, the Wyckoff method gives a generous benefit, and that is why it is a strategy preferred by the traders. This is because we cannot make a macro investment. We cannot do that because according to the Wyckoff method, the price needs to go back one more time to our area before performing a walk up to our macro line. When the price is going up, we can see the volume, we see that it is high, and this means that the big trader is participating in this climb. With these clues, it is very clear that there are big possibilities that a change in trend happens. After the price has reached our objective, we can see that the price is going back to the rank zone. Once the price stops in the rank price, we must look at the volume quickly, and here we can see that there is a low volume. What does that mean? That means that the big trader does not want the price to continue falling, it does not have any interest in the price to continue falling. When there is no volume, it means that traders are not interested in the price to continue falling since they can manipulate the markets. And if it is not interesting, it is probable that the price is invested in the opposite direction, in this case, the bullish direction. Since the big trader is not interested in the price to continue falling, here we can have an opportunity to enter with the best potential. This is because the trader has accumulated all the positions that he wanted, and now it will just let the price go up. In this case, when we take this operation, we will be doing that along with the big trader, and both he and us will wait for a big movement. We must place the stop inside the rank, and our take profits will go in the next line that we have drawn in our macro graphic. If we take a bigger risk, we can wait for a big volume, which will represent the departure of the great investor. And both he and we should close our position. Sometimes, even our macro zone will coincide with a high volume. In this way, we have made the same operation so that the trader can change a trend. To take advantage of the route, we did it with moderate capital, but we have invested with the probabilities in our favor. And we must make clear that there is not only one trader with enough money to move the market, there are many, and many times there is a fight between them toward where it should be a trend. That is why we do not must pretend to be right all the time. We need to validate every step, have good intuition, and always need to place our stop and take profits correctly. If you are already an expert, you just need to try the different entries and choose the one that works better for you. If you are starting trading, or if you are simply confused, we will make this easy for you. According to Wyckoff, the entry of step 7 is safer. And that is why we will take everything that we have learned until now and we will concentrate on that operation, simplifying operations as much as possible. In this way, you will be able to test the method, and this time we will see an example of a bullish operation. The first step is to identify the direction of the trend. In this case, it is a bullish trend. Then we need to look for a stop volume, which means that we have a high volume and that the price, instead of keep going up, is turned around. This is the first signal that indicates that someone could be entering so much money to stop the price, so it does not continue growing. For us, that manipulation is an excellent signal. That is why we must draw our first interest zone. We wait for the price to go back again, and leaves us a second peak. Once we have the two peaks, we can draw our second interest zone. In this way we have a rank. Wyckoff calls it accumulation or distribution zone, where the big trader starts to accumulate or distribute positions without the price going in any direction. In this way, it keeps a stable price once it has entered all the money that it wants in the market and pushed the price to the contrary of the trend. In this way, it sells the price more expensive, and nobody will notice that. And in step 3, we will take our operation, and we need to wait for the price to move inside the rank without giving so much importance to what happens in that period until there is a downward performance with the volume and the price falls back into the rank. And once it does that, volume must be low, and we will understand that the trader has entered all the money that they wanted inside the market, and that he does not have any interest in the price going back. Here we can take our operation. Remember that the price is inside the rank, and now we need to measure the distance between the rank's distance and project it below. This will be our take profits point. As you can see, it is not a difficult method. Once you have acquired practice with the method, you can go further. Sometimes the breach of the zone is made so strong that it is impossible for the price to go back to the rank, but we can still take that advantage and enter to the market. When the price falls strongly and then turns back, we need to see the volume. When volume goes down, it means that movement has expired. And that is when we need to make our operation. Sometimes, where there is a low volume, the price simply goes down, and sometimes the price consolidates in a small rank. Sometimes there is a rank with a false breach up, and there is where we need to be attentive to volume, since a low volume represents the moment in which the price will leave the rank. Entry rules are almost the same. We will place our stock in the highest part of our bullish movement, and our take profits will have the same size as our rank. In this way, it is simple. If the movement is stronger than the one we have predicted, it does not make sense to let the opportunity happen. It has more sense to take our operation in the next regression, and even if it seems a riskier operation, it is not, because this strong bearish movement confirms the pattern. And it makes more sense to take advantage of it for our benefit. You need to understand that in this video we have used the clearest examples for you to understand how we can spy on big traders to know their intentions. I hope you liked this video and that you will apply the Wyckoff method in your trades. Share this video so that more people can benefit from it. Don't forget to like the video and leave us your comments. See you next time.